Chris.
Yes.
Yeah. I know.
Guys,
Yeah.
all right. Hi guys, thanks. Welcome very much. We're just waiting for one more speaker and then we'll begin. Just doing an audio test. If people online can let us know if they can hear us all right. And then we'll get started in a few minutes.
Dean is here as well as off tournaments.
Yeah, because he operates out of here.
Oh, does he?
I think he does.
Okay, yeah. So I wasn't aware of that. Double if you operate from there, you know it.
Well, that's it, yeah.
Yeah. Nope.
Fashionably late. He's definitely in the building because I saw him.
Yeah, I saw him about 20 minutes ago. Yeah.
All right, you know what? Why don't we just...
There might be more people coming in as well.
I know there's quite a few people coming in online.
Oh, yeah. They're in spirit anyway. Based on the next rank.
Yeah.
You're really bursting through the door to tell us that. Ladies put on their jackets.
Thank you. All righty, so I think we will just get started.
Yeah.
So we'll wait for Dean for a couple of seconds, but in the meantime, will you just give a brief introduction and overview to who you are?
So Tim O'Callaghan, I'm an investment manager at Quintus Capital. So I look after the EIIS side of the business. Quintus spun out of an accounting firm in Cork about 4 years ago, and we invest through sort of three key business lines: EIIS, real estate, and private equity. So all focused on private markets. My background then is across various sort of lending and equity companies in Ireland and the UK.
Great, thank you.
David Swinburne is my name. I'm a chartered accountant by profession and a partner in Forfas Mazars across the street, Nation and South Hall. I look after advisory for the regions in Ireland, a couple of offices here in Cork, Limerick and Galway. And over my career, worked with businesses at all stages of the life cycle, from startup to growth phase, M&A, dispute resolution, and restructuring.
Great, thank you very much. David, I'm going to start with you. So when we talk about setting up a business, what does good financial practice look like in those first initial months, or right up to 12 months?
I think people talk about the word of governance, and sometimes people think financial governance is for big PLCs with boards and chairs and all that sort of good stuff. But from the outset, always have the word of good financial governance in your background. So like that too, if you are a company, within the first 6 months of incorporation, you have to file an annual return. Now that's just a form you file in the CRO. There's no accounts to be attached to that. But a lot of startups, incorporate and miss that deadline. Okay, and that's not good financial governance from the outset. It's quite a simple thing to do because there's no accounts required for that. 12 months later, you have to file another return with accounts. So you have 18 months before you file accounts. But a lot of times startups don't meet their first annual return. And then it's just from a governance financial perspective, it's not a good way to start. So any startup, when you're interacting with anybody, if you're looking for funding, if you're looking to get a grant, so they'll all be looking at what you've done. So if you are registered as a legal entity and haven't done that, it just doesn't start, you're starting off the wrong footing, you know. So I think at the outset, it's just start how you mean to go on, but there's good governance. What obligations do you need to meet, and make sure you meet them, and put that in as part of your strategy. Some people think, oh, finance and stuff, not for me, it's for somebody else. No, it is for you. It is your business. You're the founder. So it's just from the get-go, have that, you know, ethos of good governance in your workflows, if you like.
Great, thank you. Thanks, dear. Welcome.
Better late than never. I apologise. Sorry about that. Solicitors, you know, always prima donnas, like, you know, always an entrance.
You just start off by giving us a little bit of introduction to
Yeah,
you are.
once again, apologies for the lateness. So Dean Cunningham is my name. I'm the principal of Cunningham Solicitors. So I suppose Cunningham Solicitors is 6 years old now, and it predominantly focuses on corporate M&A, intellectual property, and trademarks and business law, essentially, right? And maybe what's a little bit interesting is my office is actually embedded in the Republic of Work, and I came here 6 years ago. I said I'd only want to stay a little while, and here I am 6 years later, and you get hooked into the community, and it's a really good community, and so yeah.
Great.
Yeah.
So you had the least amount of time to travel.
What's that expression about? Closest to the church.
Yeah, exactly.
Great, thank you. David kicked us off with a little bit of insight into what good financial practice is. So I'm going to ask you a similar question. You know,
Yeah.
When a company starts out, what is good legal practice? When should they register with the CRO? How should they start that beginning legal process?
So I suppose to start with, like, you know, looking at incorporating, what are the advantages of incorporating, and what are the other alternatives? So the alternative really is you operate as a sole trader, right? And you basically operate under your own name, but that is a risky proposition because if you think about it, you're contracting in your own name, right? And from a liability point of view, not to scare anybody, like everything, all of your personal assets are essentially on the line. That's why people incorporate companies. A company is a separate legal entity that you will use to operate through. So barring, you know, very unusual scenarios, normally you are under what they call the corporate veil of the company, right? So you're protected from a liability point of view. So you're kind of separating your personal life from your business life, right? One of the other major advantages of incorporating is the fact that you can obviously issue shares in the company, right? Now you can issue shares in a partnership, and I'll come back to it in a minute, but that's why you do it. You can give somebody one share, you can give somebody, you know, like 50% of the company, and it's just that's another one of the major advantages. I'm sure Dave will talk about the tax advantages. But yeah, like that's essentially why you would incorporate. The major one is around liability. You know, you don't want to be contracting in your own name. Really, it's not good corporate governance. But when you go to set up the company, you know, there's a particular you know, way that you can set it up, and like you're going to need a director and a secretary. They can't be the same person, so you're going to need essentially two people, and then, you know, you can structure the shares then how you want, right? So but the alternative then, and this is where people get caught out, you know, it's a common scenario. Two people come together and say, let's start business together, you know, and it's like great, and they drive on. Unbeknownst to themselves, they created what they call a partnership at law, right? And okay, there is regulation on it, but it's very, very, very old law and complex, right? And the problem with partnerships is that one partner can be held liable for the acts or the omissions of the other partner, right? So your other partner can go off and do things, and essentially that can be visited at your door, and you can be responsible for it. So that's why you go with a company. Yeah.
So great. So you mentioned two words there: sole trader versus limited company.
Yeah.
And you also mentioned you talked about partnerships, but can you just go into a little bit more detail about four founders in the room that would, how do they choose whether to go by a sole trader or limited company, and what the advantage?
I don't think there's even a choice. You have to incorporate, right? It's just the question is when you do it, and the answer to that question is as early as possible. Because if you don't incorporate, what's going to happen is you're going to be creating IP, you're going to be contracting with various other third parties, and it just becomes a real nightmare then to move the IP into a new company where there's been a long passage of time, right? And you're going to, if you have contracts in your own name as a sole trader, then you have to assign them into the company. So, like, I see problems for founders when they go through a due diligence process with investors. Mm-hmm. And, like, normally the main asset of the company is the IP, right? And it's like, where's the IP? Oh, well, we created it in our own name and then we did this. Is it properly in the company, right? So then you get into all sorts of difficulties around, you know, okay, you're transferring it from individuals to a company. How much is that asset worth? What are the tax implications of that? And it just gets really sticky very quickly, right? So my answer is you have to incorporate, because if you're a founder, you're going to want to raise, you're going to want to issue shares, and you're also going to want to make sure that you're protected.
Great, thanks. And just let's take one step back. So when you say incorporate, what is the very basic step of how do you incorporate? Can a person go out and incorporate on their own, or should they be going to a solicitor and ask, or an accountant and asking them for their help?
So incorporate, the word incorporate really just means, like, you know, give kind of birth to the company, you know, and create it. And it can be done in different ways. You can go to a solicitor and you can come to me and, you know, I can help you with it. But there are an accountant, and there's lots of online services out there, quite cost effective and pretty efficient. But I guess, like, I'm probably jumping ahead here, but, like, there's a couple of things to be kind of cautious of when you are incorporating, right? And one of the big ones that I see founders make that mistake, and none of you guys are going to make this mistake now, right? Okay, ever, right? So when you're incorporating your company, you're going to go onto the CRO and you're going to come up with the name of your company. You're going to type it into the CRO and it goes, oh, fantastic, it's available. And you're going to incorporate your company, right? You have to be very careful. Like, the company registration office, right, which is the body that is responsible for, where all the registrations are held and all the reporting is done. That system does not talk to the trademark system. So it's a common pitfall that people fall into, and they get the name on the CR and goes, sure, it's fine. And there must be no prior infringing name there. It's fine. Off I go. 6 months later, they normally get a letter from a lot of people from Sweden. Actually send cease and desist letters. So Swedish companies and German companies, and the founders are, like, they're very taken aback. It's a scary process. And then suddenly they put all their money into their websites, all the money into branding, and they're going to have to rebrand, right? And so that's a top tip. The other mistake people make when incorporating companies is, and I'm hoping I'm not jumping too far ahead here now, but, like, they will incorporate with 100 ordinary shares of €1 each, right? And that kind of makes sense. But when you think about it, then when you're going to have to kind of give, you're bringing in lots of investors and lots of different people, you can't give somebody half a share, right? So it's a mathematical thing, right? So if you only have 100 shares in issue, that becomes a problem. So the tip is to incorporate with 10,000 shares of 1 cent each, okay? And that'll make sense to you when you start looking at the paperwork, or you start working with the person who's going to help you with the incorporation, because it just makes things easier in the future. Because otherwise, when you go to do a funding round, you're going to have to do what they call split the shares. It's another process. You're going to have to take your 100 ordinary shares of €1 each and split them into 1 cent shares, 10,000, right? That's just another step that you can avoid. Okay, and the other one is just make sure that the IP is assigned to the company, as early as possible, because it's quick, and that the company is the one actually developing the IP. If there will be some IP that's been developed prior to the incorporation, what kind of happens, but it's normally in its very infancy, and there's not a huge amount of value attached to it, so it's easy enough to transfer it in. Intellectual property. So intellectual property is any property that is intangible, so you can't touch it or see it or feel it. So an example of intellectual property would be a trademark that protects the name of your goods or your services or your logo. Patents are a classic example of IP. Copyright is an automatic right that protects anything that's creative, novel, or new. And there's other trade secret law as well falls into IP. So it's essentially a form of property, you know.
Yeah.
Great, thank you.
And just picking up from that, because it's interesting, because I find when we're talking to founders, they're always talking about we, and you're like, sorry, what are you talking about? Right? And it's interesting in terms of if you do have a company that's corporated, that's what they're talking about. And it's to make sure that everything is in that and funneled through that, you know, so just important to do that, because when it does come in to look for funding and stuff like that, that's what the funder or investors can be looking at. Well, they're looking at a legal entity and everything from that. Okay, albeit you're the founders of that particular entity and maybe 1% shareholders, but it's very often some good founders, and be careful when you're talking about we, it's a bit like, well, who are you actually talking about, you know? So it's just important, and like Dean said, do it from the get-go and have it set up and then have everything funneled through it, so that there is no ambiguity around that. You know?
And like I've seen other founders make mistakes where they might have an existing company that they're kind of trucking along with that, you know, and they're creating the IP. And they've created this new company that has a new share structure, going through a funding round. And guess what? The question is, well, the IP is over in this company. It's a major problem, you know, and you get into all sorts of difficulties then around valuing the IP in terms of for tax implications.
I'm going to pull you back for a second to talk about IP a little bit more. So if we go back to, so Dean started us off with, right, we have an idea, we're building a company, we've now gone on to the CRO, we've registered it, and we've put in the basic details, and we have an entity. So let's say, so Dean, you touched on, right, you now want to set up with that, the share capital. Now, if they haven't allocated enough shares, David, how easy is that to change? Let's say they've gone in and it's 100 shares for €1. How is it easy as that change to 1 million shares for that?
So it's easy enough to do that, right? And just come back to the question you asked me earlier, the good financial governance. What we see often is that the share register isn't kept up to date. So you might have 100 shares, and then you might issue another 1,000 or 10,000 and change all that. That can all be done. But the key thing is to keep it up to date. Because very often we find as time goes on and shares might have been transferred, and there's a record here of it being held here and a record here of it's been held somewhere else, and then you might go to CRO and there's a different record altogether. So it's quite easy to, if you haven't done what Dean said at the outset in terms of a big number, yes, you can issue more of them, but the key thing is to make sure you keep a record of who you've issued them to, and keep the certificates and the original certificates and all that sort of good stuff, because again, it's when time goes on, if you're going to raise funding and you're looking for confirmation of who the shareholders are and you have different records, stuff like that, it gets very messy, and then you're into the, okay, well, what else am I missing here if they haven't got the basics done? So from the get-go, just keep on top of all those basic things, which might seem like irrelevant, not very important, but they really are when it comes to some of the fundamental things. So.
And when you say keep a record, does that mean you keep an Excel sheet, or do you create documents with share registers in your own filing, or do you need to be constantly updating the CRO with that filing, or your accountant or your solicitor?
I would say both, to be honest. Like, keep a record on Excel, keep a record of all the share certificates, and then you'll have to register any beneficial owners. So it's an RBO, register of beneficial ownership. That'll have to be done with the CRO. So anyone who owns more than 25% of the company will have to be kept up to date there. But outside of that 25%, I would just keep all records and original certificates on your own filing system.
Like the company registration office it's a record keeping obligation, legal obligation. People think that it's not effective until it's up in the CRO. You change the director, it's not. No, it's effective when the date of resignation is tendered or whatever, right? So you have to kind of get that clear. So there's kind of, that's just for the public to go and look at what's happening. But then you as the directors, you have a responsibility to maintain what they call the statutory books, right? Which is literally a list of who are the shareholders, who are the directors, who did you transfer shares to, right? And it can be a physical book, right? I have them down in my office, right? Or it can be digital in an Excel sheet. But the point is, you must have that. It's a company law obligation. And where you are going to, if you're selling your company, it will be incredibly important to the legal team on the buy side to see those statutory books, because that is the title to the shares. And I'm sure the guys have experienced this acted in sales where they're selling for millions, and they're like, "Where's the statutory books? I don't know." Like, so then that creates a real a knee-jerk reaction by the buyer. It's like, so but where it's all on the CRO. No, it has to be in an actual register. So then, as the advisor, then on the sell side, you have to reconstitute the books, which is hard if the company is 10 years old. There's a lot of things will have happened, And
also, if that's wrong, what else is wrong? So then suddenly the buyer gets scared, they get a little bit spooked, and they say, well, if you can't keep your statutory books in order, there must be other skeletons in the closet that you're not showing us.
Like a top tip, right? McGrath Seals is a company up in Dublin, right? If you're starting a company, this is a good exercise, right? Go on and buy one of their statutory registers, blank. Right? It's a hardback, it's old school, right? But it's an amazing thing for you to do as a founder, to actually write in, I'm the director, this person's the secretary, and it'll just get you thinking about that. And it's an exercise that a lot of corporate trainee solicitors would do. And it's the start of actually something very good for you,
Great, thanks for that tip. David, you kind of talked about, you started us off with, what are basic good financial practice, and we've talked about a couple of things that need to be done, that should be done as early. Are there tools out there that exist that that founders can use? Things like, even if you're just talking about VAT returns and getting in the habit of keeping receipts, are there tools founders can use on their own just to get in that good habit and good practice?
Yeah, and it's interesting because the modern world we live in terms of technology and AI and all of that, we usually expect it to do it for us. But at the outset, we talked about Excel, right? So at the very outset, just use that, because all you're looking to do is keep a record of movement and activity. So, if you have money coming in, keep a record of the money coming in, when it came in, who it came from, and likewise going out, do it without the data, without what was for, and keep the receipts, right? So obviously then when you grow, well then yes, you can go onto a platform. There's loads of different platforms and stuff can get scanned up and kept recorded. I think at the very outset, what we're trying to really make the point that keep a record, it doesn't have to be complex, keep it simple, because it's when you do go looking for funding or doing any sort of activity, people are going to be looking for the backup and for original certificates and different things like that. So I think at the outset, just use Excel. And then when you get bigger, then you can look at platforms, technology, AI, scanning from your phone and all sorts of stuff like that, right? But don't get hung up at the outset of going, I need to have some great technology to help me with this. It's just literally keep a basic record, because at the outset for your first 6 to 12 months, you won't have an awful lot of activity anyway, but just to keep a record of it, because like that, people come looking for it and you have it. So we can get hung up on AI or platforms or technology at the outset. It's just literally keep a record, and a simple record, and give you the discipline of doing that and having that in your workflow that, every Friday or once a month or whatever, that you see that that's in order,
Right.
And again, to come back to, we talked about Excel. So if you do issue shares and you update on the Excel, make sure you go and update it also on the CRO, right? So not just to do one, but follow through and everything, And it's interesting, McGrath company seals, because like that, we've been all involved in big transactions and we're looking to close and we've no seal. So we'd all have McGrath company seals in our phones. We could bring an order them quickly. But it's all that discipline, which, you might just sort of say, it's not for us, we're so small, but just keep from the get-go this good practice, because when it does come to the bigger deals and the funding, there's not to see here.
Just quickly explain to everybody what you mean by a company seal, because a company seal is a physical seal. So just a very quick one of what that means.
Yes, so it literally is a company seal with the name of the company on it, and you stamp it on certain documents that might be required, but it's just a little physical thing that you can slip in your pocket. But sisters usually have them in their drawers, but it's literally a physical structure that.
They feel very old school, but they're an important part of closing many transactions.
Yeah, you can't. A company can't. Well, it can, but it's normally executed under seal for a particular reason, because it's normally been executed as a deed, a particular type of document, which kind of gives more strength and weight. You physically have to apply the seal in either in front of 2 directors, director, or secretary, for the company to actually execute properly under seal. If you don't have the company seal, you can't execute, right? And I've seen many trainee solicitors sweating over company seals, but you can get them. They're about €50 to order with McGrath seals, and you absolutely, you need them. It goes back way back to olden times, let's just call it, right, where people had like a ring, the sink, and they would put it in the wax, and that's kind of where the process came. It's kind of, there's talks about reforming it now with DocuSign, and there's a bit of a workaround going on at the moment where you kind of appoint a director as the attorney of the company, and you can kind of execute through DocuSign. but like I can see that it's quite archaic, really, isn't it? Like have this physical thing.
But best practice is just get the seal at the very start, keep it.
Yeah.
Because when you're incorporating the company, depending on who you use to incorporate, they should be providing you with a seal. Otherwise, you'll have to call up McGrath Seals.
Yeah.
They're quick at delivering, admittedly, but you're still talking about slowing it down a few days. You don't have the seal.
Yeah.
Again, it's bad practice,
Yeah.
and you should just keep that in your drawer at all times in case you ever need to use it, or when you need to use it.
So tip, make sure you have that seal. So Tim, both David and Dean have kind of given us, good practices that a early stage company owner or founder need to be putting in practice of getting discipline around. How does that look like from an investor point of view? What impression do you get with these practices being in place, and what gives you confidence, or what you miss if you touched on it briefly.
Yeah, well, I mean, look, it's vitally important that we see good structure from the outset, that we see the company's been set up correctly, that they haven't missed their filing dates, and that good governance is in place from the outset, because it just gives people confidence that the company is primed to succeed and primed to grow in that way. Like they've done all the right building blocks to begin with, and then they can grow from there. I think it's very important to have significant clarity about everything that you do. So clarity in your pitch deck, clarity in your financials, realistic financial projections. Obviously, everyone wants to see that sort of hockey stick graph that goes up and to the right. But being a little bit realistic as well is quite important, and knowing that you can stand by whatever it is that you specifically have outlined. So clarity is very important, and putting together a structure that investors can, potentially a data room. It doesn't need to be very high tech. It can be a Google Drive. You go onto Google Drive and you can click in to see more information, and then they might have something like share certificates, more information about the founders, founder backgrounds, information about any other investors, shareholders who aren't necessarily present or as involved in the business. And then I suppose another good point to note from the outset is, in terms of good governance, it's not important to have a board from the start, but having good advisors in your side of the ring, essentially, and potentially putting together a board of people who can guide you through it. If you're a first-time founder, it's useful to have, it's imperative to have almost guidance from someone who's been there and done that before. It really helps put our mind at ease, because look, at the end of the day, when you're investing at the early stage, it's as much about the founder as anything else. And if you have faith in the founder's ability to execute, because they've shown clarity in the structure and the governance, then that'll put your mind at ease when you're reviewing the finer details.
You mentioned board there. So let's say there is a solo founder and they're like, right, we need to have a board meeting once a year. Am I just having a board meeting with myself? Or what needs to be done to kind of capture that the company has had a board meeting?
So you keep board minutes always, preferably on headed paper. You would have a board meeting. Look, in general, it's recommended to have these every 3 months, depending on the company. Sometimes it's monthly, sometimes it's twice a year, but every 3 months is good practice. The board meeting, if you have one advisor and yourself, and they're not a board director, you can still have a board meeting with them, and you can still register what's been spoken about, and then keep it as board minutes that can then be reviewed and picked up, so that people know what you were forecasting for the upcoming year, what you were looking to do in the future. But also, when you're approving or agreeing to any investment, in general, the board must approve this. So then there'll be board minutes that have been drafted up to that effect, and then they will form part of the legal documents for any investment that goes through. So when we're doing an EIIS investment, the solicitors draft up essentially like a template of board minutes approving the investment, and the founders will sign that template. It's typically sort of 2 pages outlining exactly what the investment is and that they're happy with the terms outlined.
Yeah. And
it's just further verification that they're all content with what's happening in that particular investment.
Great. And now you kind of talked about deals and how that works. Have you seen any deals fall apart because of poor legal or financial practice?
I have, but for the most part, they tend to just be slowed down, or it tends to, as I said earlier, it tends to sort of spook the investors a little bit. So the deal may fall apart for that particular investor, but someone else may come in because you have been told by that first investor, I can't go in because of X, Y, and Z reason, because of the structure, because of the governance, because you've missed some key points here. But then they can address them, hopefully over a few months, and that'll cost money and that'll cost time. And sometimes, quite often, founders lack both time and money. And if you end up faltering on those two, you can find yourself in a situation where you're chasing your tail, desperation comes, and then no investor will end up coming in as a result of it. So it is quite important not to fall at that first hurdle. So yeah, deals can fall apart, but more often than not, it can just lead to delays and additional wasted cash, essentially.
Perfect,
Yeah.
thanks. So we've kind of covered, the basics of setting up what good practice looks like, both from a financial, from a legal, how that affects you, not necessarily only in 6 months, but also potentially 10 months, 10 years down the line. So that getting into those good practices, those good habits is really, really important from the onset, even though sometimes we feel that, we can push this aside later, and it's just about creating good habits. So if we talk a little bit about investor readiness, but when we talk about investor readiness, that's not for people in the room that may be having businesses that aren't necessarily looking at investors. It could also be looking at just bank loans or debt finance. Dean, I'll start with you. What kind of documents should be in place before raising or before trying to get a third party in to bring in some external financial support?
Yeah. Okay. So if it's just a sole shareholder type company, not this point is relevant. If you have more than one shareholder, multiple founders, you need a shareholders group, right? Or sometimes it's called a founders agreement, and they're similar but different. And I can't stress this enough. If you are going into business with somebody setting up, you must have either a founders agreement or a shareholders agreement that have express provisions around good leaver and bad leaver, right? That's, we all go into companies, we all want them to succeed. Everyone is super positive from the beginning. Life happens. Somebody can get ill. Somebody wants to move countries or whatever, right? For whatever reason, but they're not actively participating in running the company. Then what do you do then? And this is where good leaver, bad leaver comes in. And like an investor will want to see that those terms are there, that you've thought about that, okay? Because there's nothing kills an investment like a founder dispute, a shareholder dispute. They're just like toxic, right? Because if you think about it, you have somebody sitting on the beach in Australia holding 50% of the shares, and they're doing nothing, right? So there has to be a legal mechanism to get those shares back off of that person. So if you take anything away from today, it's kind of the good leaver, bad leaver kind of provisions are critical. You're going to need that, right? Where there's multiple. Then you're going to have the constitution of the company, which is going to be there from the incorporation process anyway. And then I suppose, like, you know, if you have employees, you're going to need employment contracts. If you're selling goods or services, you're going to need like robust contracts that have been kind of thought through properly, and that are in place. If you have a website, you're going to need, you know, your all your cookies policies, website terms and conditions, the full array of contracts. And I think, depending on how the proximity and time between the creation of the IP and the incorporation company, you might need to have what they call an IP assignment agreement from you, the individual, or individuals, to the company. You know, so they're the kind of the main things. Like, nothing kills an investment like problems around IP, founder disputes, and issues with the cap table. Like, cap table issues are just terrible, because who owns the shares, guys? Oh, I don't know. Did we give that guy shares? Did we give him a safe note? Oh, can't even remember. And the investors looking, so how many shares do we need to get to 10%?
Yeah, who owns the shares and why? What are they doing with these shares? Yeah. What are they adding in terms of value to the company? Yeah. Don't be, willy-nilly with giving shares away to people. Yeah. And shareholders agreements are key. Or founders agreements. Yeah.
Can I just add in, before we move on, just onto that, talking about shares, can you just very quickly touch on dilution versus anti-dilution in terms of shares?
Yeah.
And whether people need to be specific about that.
So dilution just happens. It's a mathematical thing, right? It's just the more shares you issue, right, people just get diluted. If you've go into ChatGPT and play around with it, right? Just see, crunch the numbers, say, oh, there's 1,000 shares in issue. If I'm now at 10%, if I give out another 500 shares, how does that work? And you'll see you'll get diluted, right? Anti-dilution is normally what investors coming in will seek from founders, where there's what they call a down round, right? So let's just say the Series A was people were subscribing for €100 a share, and then in the Series B round it might drop to 50, right? Those investors are going to invoke their anti-dilution provisions, which means you as the founder will go way down. It'll come straight. Like I've seen founding teams like down to like 0.5% very quickly where it's down there. But that's all hard to put down the road, right? So that's dilution and anti-dilution. Like, but you have to remember somebody has to pay the piper here. The shares have to come from somewhere to bring up the person who's invoking the anti-dilution. That's the founders.
Anti-dilution is a risky business.
Oh yeah.
Yeah.
Like, but sometimes if someone's coming and putting €1 million into your company, they're going to say, we want anti-dilution. You're going to say, okay. You know, that's just the reality.
Exactly.
Think about that. Yeah. Think about that very carefully, because it means that, as they said, shares have to come from somewhere. So it'll end up coming out of your percentage. Okay, but and also when you're then raising again, there's still their share will stay.
Yeah.
It's still going to come, more is going to come out of your pocket. So just be careful with that one. David, just kind of going on to the investor readiness from your side of things, from financials, what should businesses and founders have prepared if they are going to start speaking to third parties for money? Yeah.
So we're taking as granted what we've all talked about here from a governance perspective is all up to date. And then the next thing is looking to the future, and you're going to have a projections, which is effectively your storyboard of where you want to go to. The thing to remember, numbers are what they are. They're only numbers. The key thing is your storyboard. So you have to look behind the numbers. The assumptions you're using to arrive at those numbers need to be robust. You need to be challenged. You need to challenge yourself on them and get others to challenge you on them before you go and stand in front of investors. Okay. So it's a bit like we talk about the hockey stick. Okay. We're all very hopeful and we're always looking for sunshine, right? But we need to come back and be realistic. So in terms of your storyboard, in terms of projections, in terms of your revenue, where is it going to come? How is it going to come? Is it going to come at that level? Is it going to come at that price? All of that sort of good stuff. Really focus in on that. And likewise for the costs and the inputs, who are you going to be collaborating with? Who's going to be working with you to deliver the revenue and all of that sort of good stuff. And you need to put in there what's actually going to happen, because when you do go in front of the investors and they're challenging you, they'll find you quite quickly if there's stuff that you haven't put in, that you should have put in, and you know you shouldn't have put in. Well, then you're back to that, okay, well, what else are you missing here? And the whole thing just doesn't go the way you want to. So it's really challenge yourself in terms of projections and your storyboard. What is it saying? Is it realistic? And in terms of that too, like the startup, there's lots of support out there within the ecosystem in terms of financial mentoring and all that. Avail of that. Don't be shy about it, and don't do it the day before the pitch. Do it very early on. Educate yourself. This is your business. You can't be saying, I'm not an accountant, I'm not a numbers person. You're the person standing in front of these investors or a bank, whoever you're looking for the money. So you can't be looking to the left or right for somebody else to answer the questions for you. So while numbers are what they are, there's a story behind them, and you need to know what that story is.
Just want to reiterate, you have to know your numbers. You cannot be saying, until you can kind of talk to this, you cannot say, oh, that's somebody else's problem. If you don't know the ins and outs of the numbers behind the business, then that puts serious red flags. Am I right in saying
definitely.
that?
Yeah, it's because just in terms of an accountant, because everybody might use, but the accountants prepare the numbers based on what you're telling them, so you can't blame the accountant him or her that, oh, they put them together, but they put them together based on what you told them. So it's gone back behind each of them to make up the number, the revenue lines, the cost lines, all of that.
Yeah,
all the assumptions. And, very often too, when you get first drafts and stuff, you see all these numbers and then there's nothing behind it. There's no assumptions, right? So you're like, well, it makes no sense. So I put the assumptions first and then create the numbers out of the assumptions, as opposed to the other way around, because the numbers are the numbers on the page. But but yeah, don't underestimate that you're going to be challenged, and be ready for the hard questions, and be ready to answer them. Because you want to keep the whole thing flowing, and like Tim said, see the confidence in the founders, and they might believe in you. They want to see that everything that's flowing from that follows through.
Great, thanks for that. And then just to touch on, so let's say somebody is looking for money from an angel versus a VC versus even a government body like EI or a bank. Do those financials need to look slightly different because the risk appetite of that third party is different? Could you touch on that a little bit?
Yeah, because at the outset you probably will be going for some grant funding, right? At the end of the day, you're looking for some funding to maybe do a feasibility study or get something off the ground, right? So again, too, they'll want to see, well, they'll want to support you. So they'll just want to say, if we give you this grant, where are you going to put it? And then they'll want to see you're doing that in order to draw down the grant, right? I think in terms of bank, at the end of the day, they're looking at purely at risk, as in, are we going to get our money back? Are we going to get our interest and all of that, right? Now, fundamentally, they're still looking at the same set of numbers, I feel like, Then when it comes to investors, you might be looking for more than just money off them. You might be, talk about expertise and what else they might be able to leverage off you, But again, too, they'd probably be happy to. The bank will be risk averse, whereas investors will be less risk averse. So they're going to be pricing in all of that, if you know what I mean. But fundamentally, the numbers are the numbers, okay? But in terms of how you present them, they'll still be pretty much the same, But therefore, you just go back to the core point. You need to know what's behind them, And in terms of if you are going to invest, or what else you might want off them over and above the money and the expertise that they might have to leverage off them in terms of delivering on the projections. Whereas a bank will just want to see, if I give you this, will I get it back? And they're totally detached from you. And then just go through a government body, like they'll obviously want to see, well, if we do put money in, is it likely to go to the stage it needs to go to? But again, fundamentally, the numbers are still the same numbers.
Great, thanks. Tim, you touched on EIIS earlier. Could you just give everyone a bit more detail into what that means? How do you go about it? Do you need to put, again, early practice in place to be able to claim that?
Yeah, of course. So look, first and foremost, you can complicate EIS as much as you want, but it's straightforward enough in that the government wants to incentivize investors to invest into early stage companies, and then those early stage companies should go on to employ more people in the state. So it's a tax relief scheme. It allows investors to claim back income tax that they've paid in the previous year, and that's what the government wants. They want more indigenous companies employing people in Ireland. It's pretty straightforward in that sense. Most European countries have this. We have recently sort of fallen in line with the EU norm in terms of the different tax relief levels that are available. So EIIS then specifically dealing with companies, there are some nuances and some sort of complications that you should be aware of. So first of all, it's a self-certification. So in the past, in sort of years gone by, until about 2019, I think, you went to revenue and you said, I'm company XYZ and I want to raise through EIS, and revenue would come back to you a few months later and say, here's a certificate and note to say that you are eligible for raising through EIS. That takes time. The momentum is gone. They should have thought of that months earlier. They didn't. And now suddenly they're running out of cash and they're in a bad situation as a result because they couldn't attract people through EIS. So what they did was they shifted it. So now you instead self-certify as EIS eligible. What you should do is go on to look at the tax manual or look to our website, for example, to have a look at whether or not you should be eligible. And then you essentially say to investors, based on these reasons, I am eligible for EIS, and you will be able to claim back tax relief on your investment. They make the investment into your company using a solicitor and an accountant to support that. And then you issue shares and you issue a tax cert from revenue, which gives them an idea of how much they can qualify for, the investor that is, in terms of tax relief. It's only individual investors that can avail of this tax relief. So angel investors, individual people. It's not for corporate entities. It's not for VCs, for example. Or it's for EIS funds, of which there are 3 in the country. So
Quintus being one.
Quintus being one, yes, exactly. Yeah. So that's essentially how it works. If, however, you were to breach EIS rules or if revenue were to do an audit, which they likely will over the next 4 or 5 years, they did an audit, they found out that you were lying. You weren't actually eligible for EIIS because you fell foul of one part or another. You could be liable for the tax relief that those investors claimed. So if you were to issue shares up to €1 million and the investors claimed back 50% tax relief, you could in theory be on the line for that $500,000 that the investors claimed in tax relief, or the investors could be. Either you're on the line for a lot of money to revenue are a preferred creditor, they will get their money back some way, or else the investors that you brought on board will end up getting messed around and they'll end up losing their tax relief as a result. You kind of want to be quite certain about it when you embarking upon this, which is why I'd always recommend people to speak to someone who's in the EIS industry before releasing these, and preferably speak to a tax advisor. Get them to write a quick memo, quick being about 10 pages at least, on whether or not you do qualify for EIS or whether they believe you do. Nothing will be black and white. There's a lot of grey area in this, but at least that will give you more certainty and more clarity that as long as you abide by these certain points, you will continue to qualify, and then you won't be liable for paying back the relief. So look, it's a great system because it allows companies to attract investment when investors may not be willing to go in otherwise. So if they get the tax relief back, it de-risks it, they get some of the money back in year one. That means then they're not taking a risk with the entire amount they invested, they're only taking a risk with half of it, or 65-70% of it, for example.
And just you said self-assessment. So what is that? Is there like a form that one must complete for a self-assessment? Or is it just like you said, making sure you are...
There's no form anymore. No, yeah. No. Okay. Essentially, go on to the 160002 tax revenue manual and you'll be able to see, do I fit into these categories? Am I in one of the excluded industries? For example, financial services. A solicitor wouldn't be able to raise EIS, nor would an accountant, nor would an EIS fund. Mining, certain fisheries are excluded as well. There's a list of about 10 or 12 industries to steer clear of. Other than that, then it's about the use of funds as well. So you need to be using the funds for the purpose of growing the business and also hiring at least one new employee during that 4-year term. So it's a 4-year window.
And sole trader?
No, limited companies only. So to be honest with you, limited companies, as Dean already said, is sort of the best way to get investment because as a sole trader, you can only bring someone on as a partner. You can't bring someone on as an investor as such unless they become a partnership become in a partnership with you. Investors don't really want to do that in general, so they would like to take a small percentage of the company in exchange for something that they do, whether it's offering capital to you, which should be taken as a given unless it's sweat equity, or offering additional services, joining your board, offering guidance, expertise, opening up doors for you, showing you something that you might not have known before because, as I said earlier, maybe they've been there and done that already. So limited companies is definitely the way to go if you want to raise investment of any kind. And look, it's the same with a bank. If you get a bank loan and you're a limited company, they may look for personal guarantee, but they may not. Personal guarantees quite often aren't actually worth all that much to a bank. So you're not going to be personally liable if there was a loss and if the bank were not being paid back. They're taking a very well-educated risk on the company that you've founded that you'll be able to pay it back. And with a bank, it's management accounts, financial statements for the last 3 years, and audited financial statements would be quite important too. Whereas an equity investor, might be looking at this in more of a holistic view. They believe in you as the founder, they believe in the industry, but they believe in the market, they believe it's ripe for disruption, and they look at projections and existing financials and take an educated guess on whether or not they believe it'll succeed. But they're willing to take more risk. VCs are often just looking for maybe 1 in 10 investment to hit the moon, 100x their investment, and then suddenly the whole fund seems like a great success, even though they had 8 investments that went to zero. So yeah, people in different areas and different parts of the investment world are willing to take more risk and will require different levels of information.
Great, thank you. Dean, you touched on IP earlier. So how important is it that a company has IP and keeps that structure? But also, what would you categorize as IP?
So, like, what would I categorize as IP? Well, it's essentially anything that the company creates that is you're not copying it from somebody else, right? So it's a very, very broad category of things. But the main ones would be like, around your branding and your name, right? That's covered under the law of trademarks. Copyright law then will cover anything that's created in the company that's novel or new. So like even if you wrote a policy or even if you draft a contract, that's covered under copyright law. Then you move into the kind of the more the kind of the higher of the kind of rights, which is around patents. And patents are very powerful because it's essentially a monopoly right. Okay, it's a right to exclude everybody from the use of that particular invention, and they're normally associated more with physical inventions, right? Now you can get a patent around software, and it is possible, but sometimes they're so like specific and so like pointed that the value is kind of limited. But those are the main areas. But I suppose there's the law of trade secret then, right? Which is there's things that you're going to develop in your company, like tricks of the trade. Like you're going to figure things out as you go along into your industry, and these are literally called trade secrets. And I suppose the most famous example of trade secret in the world is the recipe for Coca-Cola, right? And how they work is obviously they're kept secret, right, in the confines of the company. And they can be incredibly useful, actually, where you might have, like, a lot of IP infringements comes from existing employees and things like that. But if you have a trade secret register, right, you can literally list the things that you've figured out as you've gone along. It could be something like, oh, we got ChatGPT to talk to this other tool and this tool, and I don't know, but if everybody in the company knows that this is a trade secret, and then you find somebody has gone out and and used that post their termination, like that's a clear example of breach of IP. So, like, I would really encourage everybody to get into an IP mindset very, very early on and document what you have. The more IP you have, and the more IP that you can claim is yours, the more valuable that the company is. Okay, and that, be careful around how you're using your IP and who you're allowing have access to your IP. If you're allowing, and then like now, there's lots of investors out there, vast majority of them very reputable, but there are some people out there that want to get access to your idea so that they can use it for themselves. So obviously, if you're going into conversations, guys, rely on NDAs and credible investors, but they'll have their own NDAs. You know what I mean? And there'll be a mutual NDA that will cover both parties equally. So yeah, IP is it's a huge area, and it actually still amazes me how, I suppose it's kind of like it's kind of the bridesmaid always. Like people forget about it, but like this is exactly what you're creating in your company, but like people get fascinated with, we're building this tool and this is our IP. No, there's way more things that you have as IP in your company, down to the very minor things, the spreadsheet that you developed with that formula. That's IP,
Great, thanks. And kind of speaking about that IP and all the value you're creating, question for you, David. When a company kind of goes to raise, how do they value their company? What is that? Because it is a little bit of a projection, and this is the worth of the company, but it really comes down to the shares you're giving away. So
yeah,
how does the person go about
and sometimes that? I think founders can get hung up on valuation, particularly early on, because again, valuation is a number, right? And that's what it is. And it's subjective as well. Like we could all come up with different valuation methodologies and different numbers, right? So I wouldn't get so hung up on the action, because when you're starting out, like, what is the value? Zero, because, right? So when it comes to funding and fundraising, it's a bit like, well, how much are you getting from who for what, and where is that going to bring you to, right? And depending what comes out of that from a valuation perspective, you can only assess that at the time. Does this make sense for where you're at and where you're going, and are you comfortable with that? So I for founders, don't get hung up on value, right? Because at the outset you have no value, and so then when you're coming then to share that value with others, then you can look at what you're sharing, what you're willing to give away, how many shares you're willing to get in return, and stuff like that. Because ultimately, scenarios, you need money, and depending what you get in return. So it's not to be overly greedy as well, and like that too, you want to partner up with somebody who trusts you and you trust them, and you can work together and stuff like that. So I wouldn't get too hung up on valuation at the outset, to be honest with you. And it'll develop over time. And if you are going for funding, you'll be going to different investors and getting feedback from them and it'll naturally, and just with your own advisors to work out what makes sense at the time. So we can get hung over on value and numbers.
Is
It's
there
a negotiation.
It's a negotiation,
At the end of the day, you'll end
exactly.
up negotiating with investors.
Yeah.
You may say company's valued at 50 million.
Yeah.
Investor might just walk away.
Yeah.
Someone else, you'll say the company's valued at 50 million, and they'll say, hang on a second, it's 20.
Yeah.
And then you'll come to an agreement about something, and then finally you'll settle on it. And if they are willing to invest, use that valuation that they've placed on the company to go find more investors to bolster onto that existing round.
Yeah, there's a, I don't know if people heard of it. It's a SAFE agreement. It's called a simple agreement for future equity, and it's designed. It's a play on a convertible loan note, really. But like, it came out of the Y Combinator in California, and there's an Irish one out there that was adapted by, I think, Finn O'Driscoll's into Irish law, and it's a very basic document. It's incredibly powerful, and it deals with this problem. It's like, what's the company worth? We don't know. It's an early company. It could be worth billions, or it could be worth nothing. So this agreement, well, the way it works is the investor will put the money in, and there's no shares. There's no shares issued at that moment in time. There's a trigger event that happens, like a defined equity financing round of, say, the 250,000 or 500,000, and at that point, then the investor in the safe note will convert into equity based on the price of that funding round, and normally with a discount, maybe a 20% discount, and that's how you kind of get over that initial hump, and that can be very useful when you want to get money in quick. But a word of warning about SAFE agreements: I've seen some founders overuse them, and then you know this thing we talk about, dilution, right? Then suddenly you have a big funding round, you have maybe 50 safe notes, all convert, and then the founder is a bit like, oh, I'm down to 10%. How did that happen? You know?
Yeah.
And that comes back again to recording everything. So making sure you've got that cap table, who the investors are, what the safe is, what the dilution is, and just making sure you're keeping a track on those numbers.
Because particularly with the safe, because you're giving them a discount, so they're going to be able to get more shares for their money, right? You know? So
it's like a bridging round, essentially, to get you from where you are now to where you need to be in 6 or 12 months' time.
Right. And so just going back to that, is there, I know you said it's a negotiation, but is there a simple calculation that people can use as a starting point, or to say, right, we have built this or we've developed this, and it gives us some explanation of why we're starting off with this number?
So some industries have specific, easy to use calculations. Like if you own a hotel, for example, and if you own the freehold land, you own the building, you'll probably look at a multiple of the profitability or the EBITDA. So you'll probably be talking about maybe 8 to 12x the level of profits per annum. That's the value of the hotel. If it's in a certain location, that might be increased. Maybe we get to 15x if you're in the middle of Dublin city centre, and they believe that the value of that building and the value of the land will increase. But for most companies, in particular startups, there isn't really any particular calculation or mechanism to calculate it. But if you're a loss-making company, like a multiple of your profits is 0, or it's a negative, that doesn't make any sense. So you need to come up with a whole host of different ways to actually value it. And a lot of it comes down to the IP, comes down to the future potential in the company, and it comes down to what you believe it'll be worth in 1 year, 2 years, 5 years time. Yeah. So it's a better growth trajectory with a startup business, whereas in a concrete brick and mortar business, you can say, okay, if I was to sell this today, someone is going to pay 10 times the amount of profit that I make per year, because they believe they'll hold it for 15 years and it'll be worth a lot more.
Right.
Yeah, because it'll evolve over, depending on what sector, and it'll evolve the valuation. And like that too, if you are in a particular sector, you'll talk to others in that from their experience as to when they were raising what value or not, or again too for investors and entrepreneurs that have exited, what was their journey like, how do they go about and all of that, so it's that's why it's quite subjective. So don't get honed in on and fixated with the value, it has to be this and not that, or not doing anything. It will evolve over time and be open to that.
So many variables.
Yeah.
Great, thank you. I know we're kind of up on time, so Becky is going to send out a link. So just if everybody online can make sure that they have actually registered, and people in the room, I know you are registered already. So I'm going to open it up to questions. So anybody in the audience or online have any questions for our three lovely speakers? I'm going to just put this around so everyone can hear you.
Hi, just have a question there for Dean. You mentioned a couple of times about protecting kind of branding trademarks, like logo, branding, all the rest of it. How do you go about that practically? Like, is there a body it needs to be registered with, or how does it work in practice, I suppose?
Very good question, and thank you. So there's different registries, right? There's no worldwide registry, but so there's the Irish one, the Irish Intellectual Property Office. You can literally go there and search. You have a name in mind, do a search, okay, and see what comes up. You can go on to the European Intellectual Property Office one, and you can do some searches there. And there's the WIPO one, you can do some searches there as well. But the thing to remember with trademarks is you're only going to register a trademark specific to the goods or services that you're offering. Okay. So like that's an incredibly important thing to do, right? But the catch is, the problem sometimes that occurs is people, they do their kind of pre-clearance searches and they find, hey, the name is available. Let's go ahead. Let's register the trademark. It sails on through. You have your registration, and then somebody pops up out of the woodwork a couple of years later, and they have unregistered rights. Okay, these are companies that you have to kind of think about it logically. There could be companies out there that have been trading under particular names for a long, long time. They've built up legal rights, unregistered rights, and they can actually challenge your registration, right? So you have to kind of look basically what's registered and what's unregistered. And like it's not rocket science. Google, LinkedIn, social media, you'll find it if it's there, Yeah. So good question.
And I suppose, would you recommend registering trademarks in multiple geographies if you're potentially going to operate in them?
If you're going to operate across Europe, start with the European one. It's more expensive than the Irish one. If you feel you're just going to start out in Ireland and then you're going to branch out, you can kind of leverage what you've done in Ireland then across Europe. Since Brexit, UK is a problem that's used to be caught obviously under the European ones, but now you have to do a separate one there. But start with something, right? Start. You're going to build your portfolio across multiple jurisdictions, but very, really investor kind of like really good thing for investors to see. The brand is really cool, but it's registered, it's tight, it's there, all the certificates are there, it gives them confidence. Good question.
Cool, thanks.
Hi. So let's say my company is offering two types of services. Is it a good idea to split those two services into two different entities or two companies? And my second part of my question, what about the sub-entity? Can I maybe split the shares as 50% for the founder and 50% by the parent company, if that makes sense?
It depends, right, in terms of like a company can have multiple services and have multiple products, whatever it's doing, right? But it depends then in terms of the totally distinct services, so that they can be standalone and they're not using the same employees and inputs and contractors and stuff like that. So it depends on really what the totally distinct services, you could set up two, because one might plow on ahead of the other, its outcome, one might be sold the other. So if they're two distinct things, yes, put them into two separate entities, because you have two separate entities, two totally separate things. In terms of structures and who holds what and stuff like that, that can all be worked out in terms of who it is, what it is, like, or if you have a company with one activity and then full subsidiary and all of that, that can all be looked at and worked out at the time, depending on what you're doing, or it's money for one or not the other, and all of that.
You can set up what they call a holding structure, which is going to be tax efficient for you where there's an exit, right? But if they're if they're completely unrelated, I would say you have to remember you have to run two companies then, right? So you have double the filing obligations. But you see, what's the advantage of it is you have two players in the game. If one fails, it doesn't bring down the other one, okay? Because if they're completely different offerings.
Thank you.
Great, thanks. Are there any questions from online?
Yeah.
Okay, describe the mic.
Share setup at incorporation. You referenced 10K as a best practice. Would you go higher for a SaaS business with international plans, etc.? And what is the process to expand share count in a newly incorporated entity?
Oh, that's a good question. You can go as high as you want. I've seen millions of shares, right? Like it's just a number, right? The only thing to be conscious of is that technically, like if I incorporate the company for €100, there's €100, and I issue €100. So technically, I owe the company that money. Okay, it's just one thing to kind of just be. But like that person there, what sounds to me like what they probably set the company up with the classic 101 euro, and they want to now split the shares or redesignate them, right? So you're gonna, it's a special resolution, right? That will basically say the company has this structure now. We're going to change it to this, and you'll have the resolution underneath it, and then there's filings that need to be filed with the CRO. Exact reference to me now, but it can be done. It's not like a major thing, like it can certainly be done.
And when we move to IP section, how do you check the trademark system referred to by the panel?
I think we just had that one there. So you go on the IPOI, you can go on the EU IPO, and then there's the worldwide one, then the WIPO. And there's some really good search functionality in it actually, but there's the search bar on the left hand side, but they are all the NICE classifications for goods and services. Make sure you click those, because otherwise you're going to be pulling back thousands of results. Like it's specific to your goods and services.
Perfect. And someone said, can you name 3 EIS funds?
Quintus Capital, BVP, and Goodbody have a joint venture with Assets. Those are the 3.
And I think this is the last question. In relation to registration with CRO using virtual office space, you won't be physically working there, just using physical address as opposed to home address.
Well, I do think it's a good idea to separate it. We talked earlier about your personal life and your business life. So if you have, and a lot of people might use their solicitor's office or their accountant's office or some hub like this, but whatever address you're using, you need to make sure you get access to if there is any documentation being sent to that. But yeah, it's probably recommended not to potentially use the home address, because even when you go home in the evening, there's stuff in, you want to get away in a break from the day, and so it's probably best not to use the home address, but you can.
Perfect. I think that's all online questions.
Great, thanks. Is there anybody else in the audience that has any more questions? Great. So to wrap up, could you guys leave us with a closing note, either a bit of advice that you would leave with everybody, or what you've seen that people should avoid?
I guess structure, having the right structures in place, and clarity of thought, clarity of presentation, clarity of future projections. That's really important.
Incorporate a company. You're going to have to do that, right? And be aware of your filing obligations with the CRO. Check the trademark registry before you go creating brands. Don't get the cart before the horse. Get your insurance set up correctly. As you start making money, you really need to get your insurance. Talk to a good insurance broker. Explain exactly what you do. Don't just accept the quote for like €500 and go, "Oh, I'm covered." Trust me, I deal with these things when they become litigious, right? You need to have the correct insurance in place. I think that's it. And look, get a good legal advisor, tax advisor, accountant. Surround yourself by good people that you can go to, that you have a good relationship with, because they've been there, they've seen it all, and they can stop you making kind of major mistakes. And try and think about risk. Like as founders, I see it's always like that will never happen to me. But always try and kind of think worst case scenario, and just see how you can manage that risk.
Yeah, I think to sum it all up, and it's an old adage, fail to prepare, prepare to fail. I don't think people like to hear that, but the point is you're in a process, so at each step of the process, do what we've all outlined here in terms of, let's call it good governance, whatever you have for yourself, because if you keep doing that and keep building on it as you go through your journey, and you are in the process to be the best place you can be, stuff always pops up, but at least if you have dealt with most of it, you have the headspace to go and discuss with whoever what the issues are. Whereas if it's all over the shop, it just means there's more noise, distraction to deal with. So just as you're moving along, just how would an investor look at this? How would my stakeholders, be it a customer or a supplier, how would they view where I'm at and what I'm doing? If I was to sell tomorrow, do I have all the shares there? It's all those things that are going along. Yeah. And enjoy it as well.
Keep that. Great, thank you guys very much. I think one of the big key takeaways is just get into very good habits. Make sure you're documenting, recording, putting in, good practices in place right from the very, very beginning. Huge thank you to three of you for coming in today.
Thank you
if you guys do have questions or you need a chat, I'm sure that door is always open, and the door of Republic of Work here are also always open. So thank you very much.
Thank you.
Excellent. Thank you. Thank you, Daniel. Thank you, Daniel.
Thanks, Liz.
Yeah. Good stuff.